The insurance market operates in cycles, fluctuating between soft and hard periods. A hard market is characterized by high demand for insurance coverage and a limited supply. This typically results in high premiums, more stringent underwriting criteria, and fewer coverage options. In this video, we'll tell you how you can manage the hard market in the insurance realm. In a hard market, not all agents prosper. In fact, looking at our agencies and considering agents who had been in the insurance business for 5 years or longer, I saw a number that ceased growing or actually went backward. In the face of double-digit rate increase, how is this possible? 1. Lack of marketing. The first possibility is that these agencies were not aggressively looking for new customers and were relying solely on increased insurance to grow their income. You simply cannot do that in a hard market. Customers will shop around when their premiums go up, whether for commercial, life, or homeowners insurance. It's obvious, but unfortunately, some agencies fail to increase their marketing efforts in hard markets. And without a marketing investment, there are no investment returns. Big mistake. 2. Poor retention efforts. The second possibility is that a hard market shows an agency's weakness with poor retention efforts. You have to stay ahead of the competition. The market in the insurance industry is full of hungry agents trying to make a name for themselves. A well-run agency should have a retention rate of 90% or better and hold onto their market share because they are selling on something besides price. You must work hard to take good care of customers. In normal times, agencies with lower retention rates often see their potential plummet during a hard market. This becomes a huge double whammy. Think about the math. Rates up 10%, retention goes from 80 to 7%. What happens to growth? 3. Decrease in average commissions. The third possibility is that average commissions go down. This is because during hard markets, companies shrink their underwriting appetites, and more business insurance moves to the excess and surplus lines market at lower commission rates. Depending on an agency's insurance product mix, this can be stunningly painful. Consider an agency that writes a lot of restaurants, for example. Say the book is $500,000 in total and 50% moves to E&S markets. And assume retention drops from 90 to 80%. The agency is not marketing to new customers and just trying to keep existing ones. Commission was $75,000 at 15%. New commission averages 12.5%. Once retention is factored in, the commission on the book drops from $75,000 to 50%. A drop of 33.33%, and no chance of profit sharing on half the book. 4. Reduced agency force. The fourth is that carriers get more aggressive about trimming their agency force to save marketing dollars as part of their risk management strategy, and agencies with smaller books or marginal loss ratios lose carriers. This inevitably results in a loss of customers and income. When weather-related losses drive the hard market, commission cuts become inevitable as companies struggle to maintain margins. So, as you can see, smart agency owners have a lot to think about and proactively manage to take advantage of hard markets. What are you doing about these issues? Think about it. Get in front of all of that. Educate them before renewal on what to expect. Talk to them. Tell them you'll shop for them. Suggest ways to reduce their costs with coverage, if necessary. Provide solutions in advance of renewal. You may lose some, but you'll keep a far larger number than if you do nothing. The commission reduction on non-standard business is difficult to rectify in a hard market. The business is simply going to move back where it belongs. The best strategy here is to focus on retention and service. The next strategy, and this is critically important, is to work on account rounding. If you don't write every line of business for this type of customer, this is where your marketing effort needs to go first. If they only have homeowners insurance, pitch them on auto, life, and umbrella policies. From there, work on developing a marketing effort to a different niche that is always standard lines. If you work at this, average commission dollars will increase even if commission rates decrease. If you have a small book or marginal loss ratios, get in front of the problem by talking to the carrier and developing a plan to fix the problem. That may mean account rounding, account moving, or consolidating the book with another carrier before the agency cancellation happens. Again, your best bet is to be proactive. The final issue is commission cuts. You should complain. Then try to move as much business as possible to carriers who haven't cut commissions. Try to negotiate a new business incentive to offset OAA and SIAA. Do this very aggressively and successfully for members. Commission cuts. Ensure you are selling something besides price to your customers and consider carefully whether they need to be in a different tier, company, or rating group. When prices rise, insureds can evaluate new program structures and alternatives to traditional coverage, such as self-insurance or captives. Brokers with relationships across the insurance industry can help companies get creative by engaging other carriers and investigating unique solutions that may not have been previously considered. Hard markets don't automatically mean more money for agencies. Often, they mean less. But the owners who avoid or fix these problems we've been discussing have the best chance of successfully coming through the hard market. Good luck! Here are some more tips for managing in a hard insurance market. 1. Understand your risk. Conduct a comprehensive risk analysis to fully understand your exposure. This will help you determine what coverages are necessary and where you might be able to reduce or eliminate coverage. 2. Maintain good relationships with insurers. In a hard market, having a solid relationship with your insurer can be beneficial. They may be more likely to offer you favourable terms or help you find ways to manage your risk. 3. Work with a broker. Insurance brokers can help you navigate the complexities of a hard market. They have relationships with multiple insurers, giving them a wider range of options to potentially match your needs. 4. Implement risk management strategies. Risk management strategies can help reduce your claims and, in turn, your premiums. This could include safety training for employees, improving security measures, and implementing loss control programs. 5. Consider self-insurance or captives. Depending on your financial situation and risk tolerance, you might consider joining a captive insurance company where you insure yourself or pool your risk with other companies. 6. Consider multi-year policies. Some insurers offer multi-year policies that protect against annual rate increases. However, be sure to understand the terms, as this strategy can also have downsides. 7. Start renewal processes early. Begin your renewal process well in advance of your policy expiration date. This gives you plenty of time to negotiate terms and prices or seek other options if necessary. 8. Be transparent and provide quality data. Providing clear, accurate, and detailed risk and loss data to insurers can help underwriting. The more an insurer understands your risk, the more accurately they can price it. 9. Stay informed. Keep up to date on market trends, new types of coverage, and legislation that may affect your insurance needs. 10. Explore alternative markets. If traditional insurance options are not feasible, consider exploring alternatives such as surplus lines insurers who might be willing to cover risks that standard insurers won't. As you brave this hard insurance market, remember strategies evolve and options multiply. What other creative solutions lie beyond the horizon? Stay tuned. Unveiling new secrets of the insurance world next time.